Hey, welcome back everyone. It is time for another red hot covered call video. Hey, look, I'm behind the mic today and we're going to talk about ETFs. I get questions all the time in my inbox about why I don't use ETFs. Well, today we're going to talk about ETFs, how to select them, but also we're going to talk about the risks that come with some of the ETFs these YouTube gurus are talking about, because a lot of people might not understand the risk that comes with using leveraged ETFs. And we're going to talk about them today. But here's the deal. We're going to talk about what's important when we invest in ETFs. And I think you're really going to enjoy that. Hey, look, before we get going, you see it right there. If you've never been to my website, ctpdashboard.com, go there, download my free spreadsheets and use them. Use them because if you're going to be profitable at this, if you're going to make multiple trades during a month, 4 and 5 trades, maybe 6 or 7 trades, you have to keep the numbers in front of you so you know when you're profitable. And that's the reason I created my spreadsheets. I want you to go there and download them. And hey, look, if you like what we're doing here at the channel, subscribe to the channel. And hey, look, if you like this video today, bang that like button. It lets me know you like what I'm doing. Now look, before we get into our ETF conversation today, I'm going to take you over to another YouTube channel that I think you'll find interesting. Now, many of you might know who Chuck Hughes is. Chuck Hughes for me is a cat that I started watching his videos 2 years ago and got this great idea to use a leveraged ETF to try to pick up those fat, juicy premiums. And quite frankly, I love the story, I love the video, but I got stung. And I talked about that in a video where I used the same stock, the same ETF he used, TNA, to try to overreach and grab that $3 and $4 and $5 premium. Well, it's a leveraged ETF, and I wasn't prepared when the stock fell. Yes, I bought the stock at 70. I think it fell all the way down to 48. I was able to claw myself out and make a profit. Didn't make that much profit, and in fact, the ETF rocketed higher. So the important thing that you need to take away from this video today is that you always need to be prepared for what could happen. Whether that's good, bad, doesn't matter. You need to be ready to make a good decision if you're put in that spot. In that situation, I wasn't quite ready. Now, luckily, I was able to bail out later, making a little bit of a profit. Man, that was an experience. But here's the deal. Chuck Hughes does put together a lot of great videos. Now, look, he has a service that's very expensive. And I'm not pimping this service, okay? And in fact, I'm not going to pay anybody $2,000 and $3,000 for a service. Are you kidding me? But here's the deal. He has some great videos, and he gives you those morsels, those little morsels of information we always talk about that helps us up our game. So use cats like this to really build your knowledge, build that financial education, so when you go out and start using leveraged ETFs, or you're going to do your very first covered call trade, you do it from a place where you're comfortable, you have that knowledge, now it's time to get that experience. Well, this video right here on Chuck Hughes' page is called ETF Trade Selection. I've been watching, and I love that video because he breaks down how he uses ETFs for weekly and monthly covered call income. Now, he breaks down how he finds a stock, and he uses leveraged ETFs. And that's really the goal here today. I want to talk to you about that because I need you to understand ETFs are great to reduce risk because they are diversified. ETFs are exchange traded funds. They are a basket of stocks. They're not one stock. When I talk in my videos about me owning Bristol Myers or Whirlpool, see, there's risk there. I'm not diversified in that trade. That's one stock, one company, and if that stock tanks, like Whirlpool has been recently, I am left holding the bag. A lot of covered call writers love to use ETFs because it's a basket of stocks versus one stock. Now let's go over to a slide I created just so we can break this down. Now for a lot of you, this is going to be simple stuff, right? Why are we going to use an ETF versus buying a stock? Okay, so it is diversification, and that's the key here. Because if you look at the definition of an ETF, exchange traded fund, what it is Wall Street's created these securities that allow for diversification. They're called an exchange traded fund. So to put this straight talk style, let's imagine a company is going to create an exchange traded fund. So what they're going to do is they're going to pick stocks in a sector. Say it's the biotech sector. What they're going to do is they're going to grab a selection of stocks in the biotech sector and drop them into this ETF. Now that ETF, it's going to trade based on those 10 or 15 stocks that's in the basket. So imagine if in that basket you have Bristol Myers, Gilead, Eli Lilly. It's sort of like the Dow, where the Dow is a basket of 30 stocks. And when you hear the Dow was up 100 points for the day, well, that means of the 30 stocks, more went higher than lower. And in fact, that collection that went higher 100 points. And that's what an ETF is. The ETF is going to be diversified amongst that sector. So in the case of owning Bristol Myers stock, say you're in at 62 like I am, and Bristol Myers falls to 52 on bad news, I'm down 10 points. But on that particular day that Bristol Myers fell, the ETF in the biotech sector may have actually been up on the day. Even though Bristol Myers was down, the other 9 or 10 stocks in the basket in the ETF may have gone higher. So see how you reduce your risk? And that's why people love using ETFs. Now let's talk about the ETF and what's important to you. Look, you have to have an objective anytime you're trading stocks or you're looking to sell premium. Now in this case with ETFs, obviously, if you get a leveraged ETF, the premiums are going to be higher. I'm going to explain that here in a minute. But look, if you're looking for weekly or monthly income, you can use ETFs that trade weekly and monthly options. Now, the question is, do you understand what leveraged ETFs are? So I'm going to break this down straight talk style. Imagine that same biotech ETF. They put 10 stocks in it, and if it's up, the majority of those stocks go up, the ETF will go up. If the majority of the stocks go down, the ETF goes down. Well, Wall Street, they love their juice. So what they did is they created things like power shares that actually take that same ETF and they jack it up by leveraging it 2 times or 3 times or even 4 times. So what happens is that same ETF, there's another ETF that is leveraged 2 times and 3 times. So let's say that original ETF I was talking about in the biotech sector is up 1% on that day. The leveraged ETF that is leveraged 2x or 3x will actually be up 2% or 3%. So you could see how that juice adds to the volatility, but it also adds to the premiums you collect. And that's why people love using the juiced up ETFs, the leveraged ETFs. Now, the example I'm going to show you is TNA. I have experience with TNA. We're going to talk about how I'm going to research my ETF that I'm going to use. In this case, we're going to use TNA. And we're going to talk about the different things that are important, because the reality is picking an ETF is different than picking a stock. Why? Stocks have earnings. Stocks have profits. They have dividends. All these things we can really get our hands around. With ETFs, that's not the case. Remember, you're investing in a basket of stocks. Now look, another reason you would want to invest in an ETF or sell premium with an ETF, you have diversity and you have volume. You know, a lot of times we talk about having open interest. When you buy that stock, it has open interest. Why do we want open interest on our options we're selling? Because we want to have people out there that will buy them if we look to sell them. And when we look to buy them back for whatever reason, we want people out there that are interested in buying them. Like I've told you a couple times, I've actually written cover calls where that strike price had one person out there that was interested and they took it. Well, later in the contract, I wanted to buy the option back so I can get out of the trade. There was no open interest. Nobody was interested. And because of that, I had to sell at market, getting less than what I wanted. I had to buy back at market, paying more than I wanted to get out of the trade. So it's very important to have open interest. Well, in the case of ETFs, they have tons of volume and tons of open interest. So you're going to have these tight bid-ask spreads because there's so much volume. And if you want to write a covered call or buy that option back later in the contract, you can, because there's tons of interest. Now look, let's go over to my ETF dashboard and check out TNA and see how I break down the process of deciding whether to use TNA or not for writing a covered call. Okay, so on my ETF dashboard, look, the stock has to trade options. So for it to make it to this dashboard, it has to have options. Then, if I'm looking for that weekly cash income, it needs to trade weekly. So in my ETF dashboard, I plug in all the important things you need to know when you trade ETFs. And with ETFs, it's critical that you trade highly popular, highly liquid ETFs so you can get in and out of them. And what you're really hoping for is that it pays you a dividend as well. But let's go back to my example with TNA. So TNA, I already know it's a leveraged ETF, but let me show you what I see when I look at it with my ETF dashboard. I could sort this alphabetically, and when I sort it alphabetically, TNA is right there. So I'm going to go ahead and click watching so it highlights the entire row, because there's over 100 ETFs in this ETF dashboard, so I want to highlight it. So now I'm going to ask myself those questions. Does it trade weekly? Is it leveraged? Is it popular? Is it liquid? Is it a spider? A lot of people like to trade spiders. What's the volume? Does it have a dividend? So now with the setup complete, I really just need to see if TNA is trending higher, because if we're going to write covered calls, we really want our stocks and ETF to be trending higher or sideways, right? Because we always want to write those out of the money strikes, and maybe we have our shares taken away, which means we profited. Now, as we look at TNA, you can see a lot of good things are happening in the stock market. Remember, TNA is a small cap bull for the Russell 2000, and it's 3x leveraged. So look, as the standard Russell 2000 ETF goes up 1%, TNA is going to get jacked up 3 times. So there is a lot of volatility with TNA. And that's why option writers like Chuck Hughes love them, because they can get those juicy premiums. And I'm going to show you what they pay on a weekly basis, and it's going to blow your mind. But in this case, let's take a look at this. As you can see, obviously it has been killing it recently. And some of the things I look for, I'm looking for where it's trading in a range in its Keltner channel. I'm looking for that trading range. And usually I like to buy in when it's at the bottom of the Keltner channel. In this case, it's at the top. Doesn't mean that it can't go higher. For me, it's that feedback we always talk about. So this stock is rallying. And as you can see, the RSI is above 50. It's moving closer to the overbought versus the oversold. So if I'm buying in right now, I'm buying in a little rich. And you can see it is way above the moving averages. So for me, I'm buying in rich right now if I'm going to buy in on TNA. But let's say I want to do it. I want to go ahead and buy TNA, and I'm going to write a covered call on it. Let's check out those premiums. Now, if you've been watching my videos, I love to use Microsoft for those great weekly covered calls. And when I write a Microsoft covered call, I usually buy the stock and then one deviation out, a mere 50 cents out of the purchase price. I love to write that near term 1 week out of the money covered call and get 50 cents. So if I can get $1 in 5 days, for me, that's a profitable trade. I'm going to take it every day, because if I can do that 25 times a year, I know there's 52 weeks in a year, but look, realistically, we're not going to be able to do this every single week. So let's just say we can do it 25 times. Well, you can see if that's a 1% return, that's 25%. And hey, look, I'll take that every day of the week. We're beating the market. I love it. Well, in the case of TNA, remember, this is a 3x ETF for the Russell 2000. Look at the premiums that you would collect for a $1 out of the money strike covered call. Look at this. 5 days, you would get the $1 stock move and you would get 90 cents in premium. I mean, that is absolutely off the hook for a 5-day trade. And of course, with that comes risk, right? It's a 3x ETF. So you got to understand how leveraged ETFs work. Let's see how that works when we plug that into our mini calculator. Now, as you can see, I plugged in those numbers and look at that. So for a 5-day trade, we are knocking down 1.12% on this trade. Now look, if you do that 25 times, 30 times a year, you are killing the market. This is why many people like Chuck Hughes are going to use those weekly covered calls, and they're going to use the highly leveraged ETFs. Now look, before we get going, let's do a real quick recap on this, okay? So ETFs are commonly used to generate the same cash money I make when I use individual stocks. But a lot of people might be in retirement, see, and they don't want to own the risk of owning one stock. They want to be diversified. So they're going to buy that ETF instead. Look, there's ETFs for everything. But what's important to understand about ETFs is this. You really want to make sure you buy an ETF that has a lot of volume, because you're going to get a lot of open interest. That's critical. We get into these trades, we have to be able to get out of them. You definitely don't want to buy an ETF that has volume of 24,000 in a day. That is a joke. Got to have a lot of volume. And look, you have to understand with ETFs, they have leveraged ETFs that really can mess you up if you don't understand how they work. Hey, look, I've told the story. Before I got into the selling premium strategy, I used to try to trade BIB, which is a 2x leveraged ETF on the pharmaceutical industry. And I would make a little bit, but man, I was down as much as 12 G's on a trade in BIB. Look, you really need to understand how leveraged ETFs work. But look, if you do understand and you do have confidence in your financial experience, experience and your financial education, hey, leveraged ETFs are going to be a great way that near-term income with real premium. Now, I will say this. I'm not sure if I'm holding a leveraged ETF for more than 1 week or 2 weeks. I'm going to tell you that right now because these things fluctuate with the market. And when they fluctuate, they can whipsaw you 10 and 20 points either way. So for me, if I'm playing a leveraged ETF, this is going to be short-term for me. Hey, look, I hope you enjoyed my presentation today. If you liked this video today, I would hope that you would bang that like button. And hey, ring my bell so you get an email notification the next time I do a red hot covered call video. Next time, we're going to talk about stock selection. So I really want you to subscribe to the channel because I have a great slideshow prepared for that one. And I always appreciate the comments that you put below. Love the conversation. Hey, look, until next time, I hope all your covered calls are profitable.
All I see is signs, all I see is dollar signs.